Hi, I'm Doug Porter, Chief Economist with BMO Financial Group. Recently, we've seen incredibly strong growth from the Canadian economy, both in recent months and even over the past year. Just to put in perspective, in the last 4 quarters alone, the Canadian economy has risen by almost 4%. That's one of the best growth rates that we've seen going all the way back to the year 2000. So what I'm going to address today is, first of all, is this growth real? Is it sustainable? And what implications does it have for financial markets? First of all, let's consider, is the growth real? I think the resounding answer to that question is yes. There are many, many indicators that suggest that the Canadian economy has turned the corner over the last year, and not just GDP. And perhaps the most obvious has been what we've seen in the job market, where Canada has added hundreds of thousands of jobs. We've seen the unemployment rate drop to 6.3%. We've seen things like consumer confidence reach its best level in years. We've seen auto sales hit all-time highs. There are just a number of indicators that actually corroborate the strength that we've seen in GDP. Second, is the growth rate sustainable? I think that's a little bit more debatable. We do believe that the economy will still maintain decent momentum over the next year. We're looking at growth of a bit better than 2% in 2018, but we simply don't believe that the kind of 4% or near 4% growth rate we've seen over the past year is sustainable beyond the next quarter or so. The growth rate, the very strong growth rate we've seen over the past year, has been supported by a number of one-off items. Probably most importantly is basically a turnaround in the oil and gas sector. After dragging heavily on the economy for a couple years, activity there has stabilized and even improved over the past year, and that's given a real overall lift to growth, and regionally we've seen in Alberta. But frankly, we think that's a one-time lift that won't continue to drive the economy forward over the next year. Finally, the question is, what does this mean for financial markets? Well, we've seen this very strong growth over the past year really mean nothing for the Toronto Stock Exchange. In fact, the TSX has actually been one of the laggards in 2017. It's had one of the weakest performances internationally. So in terms of the equity market, it really hasn't meant that much. But where it has meant a lot is for both the Canadian dollar and longer-term interest rates or the bond market. And we think that that will continue to play a role over the next year. We do believe that the underlying strength in the economy and the fact that the Bank of Canada is likely to raise interest rates again later in 2017 and through 2018 will continue to underpin the Canadian dollar close to 80 cents, and it will also continue to slowly but surely nudge up long-term interest rates, even at a time when we've seen some downward pressure in U.S. long-term interest rates. So the bottom line is, even though we don't see the growth rate being maintained anywhere close to 4% over the next year, we do think it will be strong enough to still generally push up Canadian interest rates and support the Canadian dollar near current levels. That's this month's economic commentary. Thank you very much.